All right, how are you guys doing? Good? Feeling good today?
Great.
It's Monday, but gotta do what you gotta do. All right, so imagine a world where cars drive themselves. No steering wheel, no human interaction. We got surgeries that are performed by AI technology and devices that learn and adapt to our needs. This is the future, but it's the present actually, now. What is the heart behind all this? Well, NVIDIA. Hey guys, my name is Masis, and today I'll be walking through why NVIDIA is one of the most innovative companies in the world, leading the revolution of technological advancement, and why it's a stock that you should probably put your eye on. So just a little overview. How many of you guys have used a gaming PC, maybe some advanced computer, or seen some AI-driven application? And yes, that includes ChatGPT. If you have, you've most likely encountered one of NVIDIA's products. And quick fact about ChatGPT, NVIDIA was actually the backbone of developing of ChatGPT using their AI. So NVIDIA was founded in 1993 by Jensen Huang. NVIDIA is a leader in graphics processing unit technology, artificial intelligence, gaming, and data centers. Their products are used in 80% of all technological services, including Apple's AI, and Tesla's autonomous vehicles, and many more. All right, so why should you care about NVIDIA as an investment? Well, as stated previously, NVIDIA owns 80% of AI hardware market, meaning when companies like Google, Microsoft, or Amazon want to train their AI models, they heavily rely on NVIDIA. And this isn't short term. It's a massive technological shift that NVIDIA is leading. Its GPU especially creates a great difference amongst peer competitors like AMD and Intel. So let's look at some of the numbers. So in 2024, first quarter, NVIDIA brought in $26 billion, quite astonishing. Second quarter, they brought in $30 billion. Already given how much revenue NVIDIA made, that's almost 100% total revenue that was made in 2023, which projects a 200% increase from 2023 to 2024, which is quite mind-boggling. But what is their biggest revenue driver? Well, that's their data center business, which includes AI technologies and cloud services. Essentially, cloud services are internet services that are provided to different companies and individuals, whoever needs them. So let's look at some catalysts for its growth. So what's next? NVIDIA isn't stopping at just AI. They are moving into autonomous vehicles, robotics, data expansions, and development of their cloud computing. These aren't just dreams for the future. These are real billion-dollar opportunities that are happening here as we sit in this very room. Did you know by 2030, the AI market is expected to be well worth over $1 trillion. And NVIDIA's technology will be the backbone of it. That's like investing in the companies that built the internet back in the 1990s. NVIDIA isn't just riding a wave, it's making the wave bigger and constructing the surfboard that they're riding. So, of course, every company comes with some risks. There are always some variables that could affect the trajectory path of any company. Okay, my bad. But of course, that includes NVIDIA as well. So NVIDIA heavily relies on the Taiwan Semiconductor, the ticker is TSMC, to manufacture its chips, which introduces geopolitical and supply chain risks. Any disruptions in Taiwan, which includes Chinese intervention, for those of you guys that don't know, Taiwan used to be part of China, but they disassociated, but China still oversees Taiwan governance. And also, there is the inclusion of natural disasters, which could impact NVIDIA's ability to get its chips. There's also a great possibility of growing competition from AMD and Intel, which could challenge NVIDIA's market share, but obviously that is not as likely. So why should you choose NVIDIA? Well, to keep it simple, because this company is shaping the future, their technological advancements are the essence of AI development, gaming, data centers, and even autonomous vehicles. NVIDIA has the numbers, the innovation, data centers, and all the vision to continuously keep growing exponentially. If you're looking for a company that's not just leading an industry, but also transforming and shaping to what it is, NVIDIA is your stock. Thank you guys for your time.
This is really really good to see. So I just have one quick question. So I know a lot of people have been talking about NVIDIA's $3 trillion market cap. How will it continue to grow in the next couple of years? Do you think it's going to go to like 6 trillion? Some analysts are expecting like $200 price target.
So as we know, NVIDIA was the third company to reach that 3 trillion mark threshold, but it is now foreseen as the first company to cross that 4 trillion mark. It is currently sitting at roughly 3.7 trillion, so it's really close to up that 4 trillion, which is really close. So most likely in the foreseen future, it's probably going to be the most dominant factor in really all technological services in comparison to like all other companies. So I think it's a pretty good trajectory crossing that 4 trillion and possibly even more. I mean, it depends on how far you're looking in the future, but I would say it's going to be a number for quite a bit.
Perfect. All right.
Anything else? All right, cool.
Tesla. I'm Nathaniel Watson, by the way. So Tesla's financials. Quarter two, they made $25.5 billion in revenue. That's a 2% year over year, which means they're improved by 2% in their revenue last quarter two, 2023. They made a 1.5 billion net income and 5.8 net margin. The PE ratio right there, I'm not a finance major, so I had to figure this out by myself. It's very, very difficult. 61.18. That means the PE ratio is basically the price per share over the earnings per share. So that's all in all. It says it basically means that investors are usually willing to pay $61.18 per dollar of Tesla makes. So market position, why I think y'all should buy this stock, why I think we should buy this stock. It's a strong brand. It is the market leader in EVs, electronic vehicles, battery, energy storage, and automated driving. And even though it's seen exponential growth over the past 5-10 years, with new innovation, it still has the potential for growth. I know they came out, they announced the Optimus Android, they announced a new cab, and they announced a new van. I can't remember the specific names for those, but yeah. Valuation, they have a 10.47 PB ratio. This basically means it's the price per share over the book value per share. The PB ratio and the PEG ratio, they basically, both of them reflect how overvalued Tesla stock is, and overvalued in a good way because investors are optimistic about Tesla's long-term growth. So PB ratio, that's how you calculate that. If you really care, that's well, I think I already said that was price per share over the book value per share. And so basically for these two, if you have a ratio over 1, that means it's overvalued, and obviously they're way overvalued, which is a good thing, but they do not pay dividends, which is a bad thing anyway. Okay, management, the notorious Elon Musk. Some people know him as a celebrity, some people know him as a corporate leader. In our case, I'll be talking about the corporate leadership. He's made some controversial statements, some controversial actions, including his acquisition and management of X, formerly Twitter. And that has affected Tesla stock a little bit, but Tesla stock is slowly rising, fairly surely rising. I'll show you that in a little bit. But he is pretty much the reason for Tesla's success, and I believe he will be the reason for Tesla's success in the future. Okay, the macroeconomic effect. Yes, the economy is bad. It's terribly bad, and sometimes it can be amazing, but this is just what affects it. Rising interest rates, inflationary pressures. So, inflation, sometimes the government and with the banks will raise interest rates to battle inflation so that people can stop borrowing money for things, will stop so they could, not buy things that they can't afford. and that will lower demand. So that will fight inflation. Unfortunately, this is bad. Both of these are bad for Tesla because one, interest rates. Some people like to borrow money to buy a car, namely Teslas. And two, Tesla borrows a lot of money for their business expenses, their business operations. So that interest rates, that also pertains to borrowing money for business. And inflationary pressures, it also has an effect on the materials that Tesla uses. So to make their cars, namely lithium. So risk factors. Tesla stock is a beta 2 stock, which means it moves approximately twice as much as the market does. So it's very volatile, but that volatile I feel like it has a negative connotation. Of course, we saw the spike in 2022 with Tesla. Global exposure. So Tesla is an international company, so they are subject to international trade regulations. That is just something to look out for. Market sentiment. Investors look at Tesla stock as very bullish, so they see positive trends for the future. And here's also something that reflects the overvaluation of Tesla stock. Their average price target is $210.99 per share, while their actual price is $217.90 per share, which also reflects their overvaluation, also due to optimistic long-term growth. And as I previously stated, you have the spike over here in 2022. This was caused by optimism and hype in EVs and strong financial performance. But however, you see, it's not a very sharp downturn, but it's fairly sharp. This is due to rising interest rates, the acquisition of X, and he made some questionable managerial decisions. So that kind of reflected on Tesla stock. But also you have competition such as Rivian and I think it's BYD, EV companies. But Tesla is increasing, and that is because of recent improvement in performance and deliveries and technological innovations. That is it. Thank you very much.
Thank you, Daniel. That was really good.
Thank you.
I have 2 questions.
Okay.
Can you share a little bit about the robotaxi event and why you think the stock fell so much following the event?
I think you said the robotaxi.
There was a event where they came out with a new van and like some robots.
I did not know that the stock fell after that, but I will have to research that though.
Sure.
Next question.
And then, why do you think Tesla stock has been so volatile over the past couple of years, besides like just the macro?
One, I know this is, some people might think this is cliche, but it's Elon Musk. It's Elon Musk. He's not your typical, he's not your typical CEO appointed after like 60 years of service. No, he has some of the things that he does outside of the company. A lot of the things actually reflect Tesla's stock. I'm pretty sure, of course, he just endorsed Trump like a couple weeks ago. I haven't seen what that did to the market, but I'm pretty things like that affect Tesla's stock, and that's one of the reasons. And mainly because it's very popular, so it's a big name in the market, and that's why I think it's very volatile.
Sure. All right. Thank you so much.
Thank you very much. Thank you.
If there's one thing that has become drastically ubiquitous in today's society, it's smartphones. Everybody and their mom has a phone. However, the value of these phones doesn't come from its factory features. Instead, it largely depends on a huge ecosystem of 9 million apps, app creators, and advertisers. When there's so many apps that exist in the world, it's often hard to find the right apps that best suit someone's needs. That's where AppLovin comes in. AppLovin software solutions use a machine learning recommendation engine to find and recommend the users most likely to engage and download one's app. They also help creators implement in-app bidding for ad space, which helps generate ad revenue that creators can use to update their app. Hi, my name is Jonathan Chang, and today I'll be sharing with you why I'm loving AppLovin right now. I'll be doing so through 5 major categories: valuation, growth, profitability, momentum, and revision. Firstly, let's start with valuation. Is the company overvalued or undervalued? One of the most common measures of valuation is the PE ratio, which compares the stock price to the earnings of a company. There are 2 measures of a PE ratio: price of earnings over the past 12 months and price over projected earnings into the next 12 months. The trailing 12-month PE ratio of AppLovin is currently 62.49, and the forward PE ratio is 42.91. This shows that there's a bit of a premium to buying AppLovin. However, these numbers show that AppLovin has accelerating earnings. A better measure of valuation would be the PEG ratio, which measures price over earnings over growth rate. AppLovin's PEG ratio is 0.92. When we factor in growth rate, we can see that AppLovin is actually vastly undervalued compared to its peers. With a market cap of under $50 billion as well, this large cap company has a lot of room for growth and has the potential to capitalize on a lot of market share. Next, we'll move on to growth. What are AppLovin's growth prospects? Firstly, AppLovin's revenue growth year over year is 37.31%. AppLovin has already increased its revenues from the previous year by more than a third. They also have a large recurring revenue rate due to their subscription and ad-based models. Furthermore, AppLovin's stock ownership consists of 38.31% of insider shares. A large percentage of insider shares shows that the executives in the company actually believe in their own company and its prospects. It also helps that AppLovin is a sector-leading stock in a fast-growing industry. The global mobile app market is expected to have a compound annual growth rate of 14.3% by 2030, which will help accelerate AppLovin's growth even more. Lastly, AI for AppLovin is not just a buzzword, and they actually incorporate it into their Axon machine learning engine to match prospective users with the apps that can benefit them the most. Now, on to profitability. Is the company profitable? As we talked about, AppLovin provides software solutions that help creators monetize their app, acquire ideal users, and create ads that perform. Moreover, AppLovin creates and helps to publish mobile games through operating blind studios, where they take a cut of in-app purchases. I believe that AppLovin's economic moat is wide because of the variety of software solutions that it provides and marketing tools that help creators track their progress. Creators that find success in AppLovin will stay loyal to the company as well, further reducing competition due to AppLovin's head start in this niche. AppLovin also generates large amounts of free cash flow. This graph shows the revenue, free cash flow per share, and total common outstanding shares over the past 3 years. The trend we're seeing is that AppLovin's revenue and free cash flow per share are steadily increasing, while the total common outstanding shares are decreasing. This means that the company is generating enough free cash flow to buy back shares, which inflates the stock price and increases earnings per share. Next, momentum. Is the company in a solid uptrend? AppLovin stock is currently down about 0.41% from its 52-week high, and up 326.71% from its 52-week low. This means that the stock is constantly pushing new highs and has been experiencing super performance growth over the past year. One of the most important indicators of a strong uptrend is relative strength rating. Relative strength rating is a metric from IIBD, which compares a stock's performance over the past year to all other stocks. AppLovin has a relative strength rating of 99, signifying high strength. I also use simple moving average indicators to determine if a stock is in a solid uptrend. What we're looking for is the stock price to be above the 50-day moving average, which is above the 150-day moving average, which is above the 200-day moving average. This means that the stock is steadily increasing rather than having volatile spikes. Lastly, earnings revisions. Is the company beating expectations? Over the past year, AppLovin has had 15 EPS up revisions, 0 EPS down revisions, 18 revenue up revisions, and 2 revenue down revisions. This demonstrates how AppLovin is continually beating expectation and producing alpha, or market outperformance. In conclusion, I would give AppLovin a buy rating due to AppLovin's undervaluation considering growth rate, its multitude of growth prospects, profitable revenue streams, free cash flow generation, solid momentum, and revision trends. The mobile app market is something that will continue to grow and stick around in our technological society. And AppLovin will be instrumental in alleviating the disconnect between developers and customers now and in the future. Thank you.
This is really good. I'm not too familiar with the company. If you had like 20 seconds to sum up what the company does, what would you say?
Yeah, so AppLovin produces software solutions such as app discovery, which helps creators find like potential like customers and like with like targeted ads. And then they also have Max, which helps developers generate ad revenue from their company through like ads in their applications and stuff like that.
I have a question. I was curious, what are some of like AppLovin's competitors in this industry? Because I don't really know too much about this industry.
Yeah, I've seen a couple of AppLovin competitors, mostly through like a Seeking Alpha. They have a couple of companies that show up there, but I'm pretty sure that there aren't many customers that or competitors that do exactly what they do because obviously they have a ton of like software solutions that can help like creators generate ad revenue and also like implement into like any type of mobile application. Also, AppLovin operates like Lion Studios, so they also help publish games as well, which is like a combination that not a lot of other companies are doing. Thank you.
That's really good. Thank you.
Thank you.
Well, this one's not going to be as good because that's like following Sinatra. That was good. But so the stock that I'm going to talk to you about today is going to be Caterpillar, or I might refer to it as CAT. That is its ticker symbol. And then I'm going to tell you why it is a good stock to consider investing in. So here's just some background information about the company. CAT is one of the largest global construction and mining equipment manufacturer. It's involved in so many different sectors, like anywhere from mining to oil to gas to transportation. And it's a leader in a lot of these sectors and even in the global economy. And then it is the 41st largest company in the S&P 500, and it's got a market cap of nearly $200 billion, which makes it, one of the larger cap companies in the S&P 500. And then I found this really interesting. For 14 straight quarters, they've had earnings have increased. I think that's pretty impressive. That's kind of new. Okay, so I kind of compared over the past couple weeks. So this is over the past 3 months. I compared it to the S&P 500, and obviously, they're not the same. But I wanted to focus on kind of right here. You can see that Caterpillar takes a dip, but not as much as the rest of the market here. It kind of stays very stable, while other stocks may take a dip during this time. And then, so during the market actually lost. I think it was like, you know what? I'm not gonna say a wrong number here, but the Caterpillar gained nearly 2% over that time frame when a lot of other companies were losing money. And then so in the past 2 weeks, they actually just appointed a new board member. This is Mrs. Keene. She's hired on for the Nominating and Governance Committee and Human Resources. So she originally started her career in the IT department. So she was more responsible for making sure that information moves between companies and a lot faster and more efficient. And I think that with this, she might be able to help CAT with their just global operations all over the globe. And then, here we go. This is just kind of showing you how over a long period of time Caterpillar is a very effective and great investment. Because if you would have invested $1,000 10 years ago, you'd have about $4,000 right now, which, I mean, that's insane. That's that's over 300% returns. And then in comparison, like if you would have just invested in like a mutual fund, you probably would have only gotten, you would have gotten less than 200%. So it is a great way to build money without really having to do anything. And then even if you invested a month ago, you'd have about $19 more in your pocket than you do right now. And that, I mean, it might not seem like a lot, but over a month, $19, that is great returns. And then, okay, so actually I made this presentation last week around like Thursday and Friday I was working on it. And then I was checking over it today and I got about 1 million notifications from Yahoo Finance. So I was trying to figure out what was going on, but apparently this morning a bunch of panic happened on Wall Street because people think that Caterpillar is doing like, they're becoming worried that they have too much inventory and not enough jobs. So they're worried that there's just not enough revenue coming in, so they are scared. And then you see here, this is right about when I got a bunch of notifications around, I want to say like 11 a.m. this morning. My phone and watch are just blowing up, but you can see people just, obviously some people sold here and just throughout the day, but it did stabilize. Now it opened at like, I want to say it opened right at 400, and obviously it's down today, but yeah, but again, it is still a pretty consistent stock, even though it is, you know, down today, but you know, there's always tomorrow. And so in conclusion, I think that Caterpillar is an established company in the stock market, and I think it is a great way to receive returns quarter after quarter. And with the addition of new members, I think they're going to have great innovation going forward. And obviously, based on the data, if you invest in Caterpillar, you should have high returns. So that's why I think it's a great stock to invest in.
During your presentation, you talked a lot about Caterpillar's growth over the last like 10 years, 5 years, even last month. What are they doing to grow?
So really they've just kind of focused on more like, they've started to focus on American construction. Like, I don't know if, have you ever seen like the big yellow trucks out there? That's what they make. And so before they were focused on, like I said earlier in the presentation, they had like oil and gas and stuff like that. But now that America is, I guess, trying to create more jobs, and then there was also, I might butcher this, but there was something about pipelines needing to be replaced, and Caterpillar has some sort of contract with that. I don't know all of the information. The article was really, really short and really, really vague, but I can find out more information if you need.
Sure, yeah, that was a really good presentation though.
Thank you.
Thank you.
Okay, my name is Luca, and I'm going to present a little bit about Microsoft. I don't have that much of a script right now, so I'll do it not that pretty, but let's see. So, first of all, I wanted to invest in a stock, first we have to understand what the company does. That's, for me, the most important thing. So, Microsoft is a tech company, very, very big tech company right now that was founded in 1975. So what they do is just digital technology and AI available broadly and doing so responsibly. So they offer a lot of things. These include cloud services as Azure and Microsoft 365. And we have software products, the operating systems and productivity tools as Windows or Office. I would bet that any of you would use Excel or Word for almost every assignment. So then we have devices and hardware, we have PCs, we have gaming consoles such as Xbox, we have and tablets and much more, and they have consulting and support services. So now I wanted to analyze a little the liquidity and solvency of the company. So because of the time constraint, I had to just limit myself to to very few ratios. So for liquidity, I wanted to look more at the current aspect of things. So we can see the current ratio was a 1.27. What does this mean? So when the number is above 1, this means that the company has more current assets than liabilities. Advantages of this. So the company is in a very good position to meet the short-term obligations. And what does this, when companies have 2 or more of this number, it means they do not use their assets that efficiently, or their assets are not they're non-productive assets, they can hold a lot of cash. So that's not very good. So that's why the approach of Microsoft is a lot less conservative as other companies. So this can be a very good point of view for some investors. So now I'm going to analyze a little bit about solvency. I chose the debt to equity ratio, which is 0.36. What does this mean? So we can see there that the capital structure of the company is organized basically on 73.5% equity and 26.5% debt. So this is relatively low debt, which is an advantage, which, if you see it in a investor's perspective, because it provides financial stability, because since the company doesn't have that much debt to pay, they're very secure. So they do not owe anything to almost anyone. So that's why it's low risk, and many long-term investors would be very interested in this type of companies to not look at it each day to see what's up with the company. Now we have a little financial overview and growth of the company. So as I mentioned before, this is a tech giant. So just by the revenue, you can see $245 billion. That's a lot, and this is well, you can see that it's a strong revenue base, and they're an established company already. So this is very good to investors. You don't have to research that much on unknown companies. Then we have the earnings per share growth. So this is very it's very good to see the projected growth the company's having. So we can see that it's efficient with its profit generating. And also, the future earnings potential is very, it's quantifiable. So in this way, investors can guide themselves to, do I invest in this company or not? Here we can see the profit margin. They're almost 36%. What does this mean? So this is a very high profitability for a company this big. And this is even more surprising to me, because they have a lot of competitors. When I see this type of companies, they have competitors all over the place. You have Apple, you have Amazon, in everything. So it's very surprising to see this, and they have a lot of competitive advantage because of this. So they can put high prices on stuff, and they customers will not go away because they have something very valuable to offer. And finally, so we have sales growth this year. It was 15.67%. What does this mean? So this just means the demand keeps increasing, so they capture their more customers, but they retain the ones they already have, which is very important for a company. And then we have, just signaling revenue growth. And last ratio that I have today is price earnings to growth. This is 2.4. So what does this mean? This is high investor expectations for this company, but you might be wondering, why is it red? So when I was doing this research, I was like, why is the number red? Everything else is green or white. And I researched, and it's because the stock has a lot of potential for overvaluation. When this ratio is 2 or more, you have to be very careful. Because if the investors' expectations are not met, this could mean that the market value of the company will go, the market share of the company will go down. So this is a very important thing to consider. Okay, lastly, I wanted to talk about market position and risks of the company. So, Microsoft currently is one of the leaders in cloud computing. They have things that I mentioned like Azure and Azure, that it's like is the second cloud, like the second cloud. I don't remember the name. I'm sorry. Like thing for in the world right now. The first one is Amazon's AWS. So this just means that they're very big in what they do, such as cloud computing. Then we have dominant in productivity software. As I mentioned before, you've seen Excel, Word, and all of this stuff. Like they use it everywhere, like in every school all over the planet. So it's very important to know that, and it's one of the leaders in AI. So this thing Azure that I mentioned has a lot of AI like functionalities, and they even have Copilot, that this is something that assists you like in an AI way in applications and much more stuff. But we have then the risks. As I mentioned before, this company has a lot of competitors all over the place, as you can see in the cloud, in gaming. So because of this, like they have to be a lot like they have to make sure, oh, what is this company doing? What is this other doing? Because if another company gets a better product than them, they have to work and they have to work hard to just equal those efforts or even get better, because like they could go very down from this. And they have a lot of dependence on key products. As I mentioned, the Microsoft 365 and the cloud is one of their biggest revenues. So if this fails, like their operational they will have a lot of operational challenges. Thank you very much.
Thank you. This is really good. I like that you mentioned all those ratios. How do those ratios compare to that of the sector? Like,
I really wanted to include that in my presentation, but I did not research enough. But like, I really wanted to do that. I can tell you an answer after this.
okay.
No, but I actually knew that was important, like to know that, to compare.
Yeah.
I have it in my mind. But I'm sorry I couldn't answer it.
No worries. Thanks, Drew.
Thank you.
All right. Thanks, Luca.
Hi everybody, my name is Shivani, and I will be doing a stock pitch on Tapestry Incorporated. So who is Tapestry? Definitely not tech. So it is a luxury brand, a hub of iconic brands like Coach, Kate Spade, and Stuart Weitzman. And so they were founded in 1941, originally by the name of Coach, until they acquired two new brands to kind of showcase their diverse portfolio, and that's when in 2017 they rebranded as Tapestry Incorporated. Now I'm a marketer, so this presentation is going to be a little bit different. So I say when you invest in a company, you really have to see how they relate to a consumer. How are they going to be innovative to be different from their competitors? And so that's why I want to analyze their strategic vision. So it's kind of three pillars here. So there's brand enhancement, digital transformation, and social responsibility. So what Tapestry does is, first, it's their acquisition strategy. So right now, they were pending an $8.5 million purchase of Capri Holdings, which is also a hub of many big luxurious brands like Jimmy Choo, Versace, and Michael Kors. And they're projected at 15% combined revenue growth post-acquisition. Digital transformation is big right now. The way that consumers spend, the way that they navigate a website is big when talking about conversion rates. And that's exactly what Tapestry invested in all e-commerce platforms that optimize online sales. And in the fiscal year of 2024, the e-commerce segment generated $2.1 billion. Social responsibility. So now when you're looking at a company, when you're investing, you have to see, because nowadays consumers don't just want a brand that does well. They want to invest in a brand that will also put in the work to help our world, help our earth, right? And so that's what Tapestry does. And so with their purpose strategy, they aim to achieve 100% recyclable and sustainable source material by 2030. And they've already reported 22% reduction in operational emissions in the fiscal year of 2022. So moving on to the actual data, their current share price is $45.59 with a market capitalization of $10.54 billion, which is a good mid-range. Their P/E ratio is 12.94, which we'll expand on. The dividend yield is 3.09%, and the 52-week high and low is which a low of $25.99 and a high of $48.80. And so these are kind of some ratios that I've picked just because I think these are the most important to know when investing in a luxury brand. And so the price to earning ratio, as I've said, is 12.94, which is compared to the industry standard of 15, which means that this stock is highly undervalued. So it leaves Tapestry to trade at discount, leaving room for potential price gains as it becomes more recognized. And so if you're a value-oriented investor, this is really important to know. Operating margin, so we are at a 17 where the industry standard is 13, which is well above the industry standard, which represents that they're generating more profit from its sales, allowing them to reinvest in innovation and expansion. Free cash flow, they're about $1 billion right now, which is lower than their competitors, but it gives them more room to grow, especially when they're now acquiring Capri Holdings. And so it shows their flexibility to return value to shareholders through dividends, which is the 3.09 dividend yield, and investments, which leads us to the debt to equity ratio, which is the 0.7 for Tapestry, which is 0.1 above in the industry standard. So this kind of shows that they have a mix of debt and equity to finance operations. They aren't too reliant on borrowing and won't be impacted too highly by interest rates, but this proves that they can, when they do purchase Capri Holdings, that they can handle their finances as well. Kind of moving on, with any stock that you buy, there are investment risks. And so what are Tapestry's investment risks? It's intense competitions. When you're in a luxury business that has a huge history, like with Louis Vuitton or Hermes, like things like that, customer engagement is super important, and that's something that Tapestry kind of does differently, which is kind of shows their growth rate a little bit more. The loyalty programs, they've had about 18 million more customers in their loyalty programs just this year, which is a 15% growth from last year. They have more personalized marketing than a lot of their competitors, which is geared to their wide age range, which is why they acquired Kate Spade in the first place, to kind of gear towards a younger market. The limited edition products and partnerships are more geared to millennials, especially when they partner with Keep Haring. Changing consumer preferences, so they have a very strong brand portfolio to mitigate market fluctuations and consumer preferences, and they have very active market research and trend analysis. Economic sensitivity, so they're a very global brand, so this kind of helps mitigate some stuff for the diversification of revenue streams. So if there was a slowdown in North America, it could be offset by strong sales in Asia or Europe. But all in all, luxury products often demonstrate quite resilience in economic downturns, so that's a good industry to invest in. Okay, and then now the revenue breakdown. They just kind of gave us more of a breakdown into each sector of their brand and what their sales were. And so Coach made $5.1 billion net sale this year across 60 countries. And this kind of shows how they want to grow it for next year. And so they're going to deepen connections with consumers, grow leather goods, fuel gains in lifestyle, and expand on retail experiences. Kate Spade will drive customer acquisition, so that means making sure that they are more connected with their consumer base and not just making personalized recommendations like other brands have done. Maximize omni-channel opportunities, so making sure that it is seamless flow through all in-store purchases or online or mobile. And then Stuart Weitzman will be expanded to new categories, because right now 100% of their sales are just footwear, and then fuel brand relevancy with emotional storytelling. So, all in all, Tapestry exemplifies a strategic blend of iconic brand management, innovative growth initiations, and financial robustness. With their detailed revenue breakdowns, we can see their ability to navigate market challenges and grow revenue. And Tapestry offers a huge growth opportunity for investors.
This is really good. touched on kind of everything with the company. One thing I want to ask about the consumer preferences. I don't know too much about the fashion industry, but I know that fashion trends are constantly changing. Sometimes it's baggy jeans, sometimes it's skinny jeans, whatever. How does Tapestry react to those changing consumer preferences? Do they constantly change the design of their bags or something? Or?
Yeah, so they have a lot of data analytics that they use, so they can track where people go on their website, and then also because they have a lot of social media campaigns, they're able to kind of get feedback from what people want and like see which bags that they post online is getting the most market and seeing what designs they like as well. And so they're not changing all of their bags, they're not changing all of their accessories, but they are tweaking them to so it's like not as much money to create a whole new product. So
Okay, nice.
I have a question. You said it had like a lot of like involvement internationally. Where is it based? Like where is it?
it's
from?
based in New York, but they have companies in Europe, Asia, Japan. They opened.
Yeah, I think might be completely wrong, but most like the designer brands are European, right?
This one's not. This
No.
one's not. But Louis Vuitton and stuff like that.
Yeah, that's something like that. Okay.
Yeah.
So I'm Dirty and I'm going to be presenting about Palantir today. Okay, so for a company overview, Palantir was founded in 2003 to help intelligence agencies make better use of their data more securely. Today they use services like their Palantir Gotham, Founder, and Apollo to understand and defend against threats in national security and cyber attacks. And recently, they've come up with their artificial intelligence program that's the most popular right now, and it allows clients to integrate AI into their workflows, helping them automate and enhance their decision-making processes. So for the business model, there are subscription-based services to analyze vast data sets. Most of the revenue comes from like long-term contracts with the government that they've already had, and they're now trying to expand into commercial clients as well. They also have a bunch of fees as well that go with it. And the artificial intelligence program is kind of critical for their long-term strategy, and it differentiates the company when it comes to competition. And they have a lot of high customer retention with people that choose them. So for some recent achievements, Palantir was ranked #1 for a lot of things in rendering AI, data science, and machine learning. And over there, you can also see it was ranked in market share and revenue. Something that's a little different, with Palantir, investigators are uncovering human trafficking rings, finding exploited children, and unraveling complex financial crimes. So that sets them apart from other AI companies as well. So to now kind of dive into the different financial ratios, their current price per share, I know this yesterday, but right now they went down a little bit today, 43.40 I think. And the 52-week range has been from $14 to $44, which has been a lot in just this year. And their market cap is $97.438 billion. And it shows that it's a large and well-established company with a lot of investor confidence. So for their free cash flow, it's crucial for determining whether Palantir can sustain on its own without kind of external finance. So the positive cash flow kind of shows financial stability and an ability to reinvest in its technology. And for their gross margin, they're consistently high, and they're monitoring it, and it can help kind of determine Palantir how it can maintain kind of profitability and sales as well. And I chose to also talk about the price to sales ratio. I know the PE ratio is pretty common, but the price to sales ratio is kind of better for Palantir just because it compares stock price to revenue, how much investors are paying for each dollar for the revenue. And Palantir's valuation is largely driven by hope for long-term investment rather than immediate revenues as well. Kind of diving into their revenue growth rate, just in the year it's gone up 27%. And it's a direct indicator of the company as it shows a success in operations and gaining new clients as well. And Palantir moving forward wants to kind of expand to commercial sectors as well. So that kind of adds to it. So why kind of these ratios that I've chosen to talk about? This company is in its growth phase, so investors are concerned with generating sales, maintaining healthy cash flows, and operating efficiently. And valuation, since profits are not that consistent, the price per share, that ratio can kind of help show if the stock is fairly valued. And financial health, the cash flows show the company's ability to fund its growth without raising debt or kind of diluting their stakeholders as well. So kind of diving into more analysis about the company. Their strengths, like I mentioned, they have strong government contracts, high gross margins, and one of the bigger leaders in AI recently. Weaknesses, they kind of have high operating costs because they do a lot of research and development, and there's also a lot of sales and marketing that goes with that. And dependence on the government, so if the US budget kind of goes down, it kind of loses that in the moment, and revenue could take a hit if that were to happen. And it's pretty volatile, it's a riskier investment. And for opportunities, kind of expansion into commercial sectors, so they're also just non-government, but also want to go into healthcare, finance, and other businesses as well. They also want to expand globally. And their AI and machine learning integration is just constantly evolving, so that's a great opportunity for them. When it comes to threats, obviously there's a lot of competition. Like Luca mentioned, Microsoft and all other big tech companies are big competitors. They have the regulatory risks, so since they are involved with the government, they kind of have to be a little safe with what they do. And they are considered overvalued during the high growth stock boom, so if growth were to slow, the stock would also face more pressure. So future projections, right now from the Q2 earnings, they were doing pretty good, and they had $678 million in revenue. And they've been good in their 5th consecutive quarter of the GAAP profitability as well. And they've had a net income of $135 million with earnings per share of 0.6. And to look into this next year, it's forecasted to hit almost $50. And long term, by 2030, many say it can skyrocket to even $275. However, competition will only grow and could limit short-term gains, but investors should kind of balance both the upside and the risks when considering Palantir as a long-term investment. Thank you.
Really good again, Vicky. Obviously, Palantir's been a big name for the last several months. It's been growing like crazy.
Yes.
It's an S&P. What do you think has been the main factor for this growth?
I kind of think not to say it's their AI, but it is. And they have been kind of branching out a lot more. So yeah.
Yeah, just high demand.
Just high demand, yeah.